So we have to talk about a certain country. And no, it's not Germany or China or even the US. It's another country that is really important to world markets. And something is going on with the rates. And it can possibly tell us what's going on with the rates in the US and the direction of our stock market. Stick around, we'll get to that and so much more. Hey everybody, RC Peck here with Fearless Wealth, and the main job is to make sure at Fearless Wealth that you retire strong. Now, there are so many different assets and asset classes that are interconnected. I want to look at one specifically this week because there's a big change, or at least I think there is a big change coming. So I want to get to that, and I want to talk about how it influences and impacts people's portfolios, especially if you're over the age of 60. Okay, let me get over to the price charts. I'll share my screen and we'll get to it. All right, so let's pop over here. Okay, this is the first of three charts I want to show. So I want to just kind of stay pretty specific today. There's two lines on this chart. One line is Japan, it's the orange line, and the other line is China. This is telling us how many of these countries, whether it's Japan or China, how much of their bonds or our bonds do they own? So Japan owns about 1.1, that's actually, it's 1,100 billion. Sorry about that. $1.1 trillion worth of our bonds. The Japanese government owns $1.1 trillion of US government bonds. Now, compare this with China. Now, back in 2013, China was the biggest owner of our bonds at 1.3 trillion. Today, China, quote unquote, only owns about 850 billion. They've been selling bonds since 2013. Let's just call that a decade. Over the last decade, they've gone from 1.3 trillion. They're almost down at 600 billion. Well, during the exact time period, just when you look at that whole time period, Japan owns the same amount. In 2013, they had about 1.1 trillion, and today they have about 1.1 trillion. So what Japan does has a bigger impact on our bond market in the US than what China does. And that's why moves in China just don't mean as much as they used to. So what I want to do is show you this rate right here. So if you can see my screen, and actually let me get some more real estate showing. So this is the yield of the 10-year Japanese government bond. Now, it's hard to tell, but that red line that's on the screen is when you were getting 0% on a 10-year Japanese bond. You give your money to the Japanese government for 10 years. Every time the black line was below that red line, they would not give you anything back. In fact, you had to pay them. They were yielding at some points negative 25 basis points, also known as a quarter of a percent. But since the beginning of 2022, when the market peaked in the US and probably almost everywhere else around the planet, remember the market peaked at the very end of 2021, the beginning of 2022, the yield of the 10-year broke out. And I know it's not big, it's not a big number. It went from 15 basis points and it hit a high of almost 55 basis points. But the point is that yield was going up. Finally, Japan was paying more for people to hand them their money for 10 years. Now, this matters because at the margin, it's a competition to the US 10-year Treasury. I know. The US Treasury today is paying about 4% or 400 basis points-ish, a little over. And the Japanese government's giving you 44, or basically about 1/10. But Japan is doing this thing called yield curve control. And I believe they're about to increase the range it's allowed to move. If it gets above the range, they come in and they sell a bunch or they buy a bunch of their own bonds to hurt people. So people have learned to believe Japan's going to do whatever they can to control their yield curve. But right now, they're at 0.44. I believe they're going to increase the range higher, and that's going to pop up the yield on the 10-year Treasury, which I know it sounds crazy, but it starts to give competition to the Treasury in the US, the 10-year. If that's the case, the yield right now in the 10-year Treasury today is about 4.04. If Japan raises their upper limit, then I have to believe the 10-year in the US is going to have to respond by going higher. Now, if that goes higher, bond prices go lower. I know bond prices, bond yields, it's very confusing, but this could put additional instability into the market. Now, I want to show you one more price chart and then I'll wrap this up. Now, if you look at the screen here, there are three squiggly lines, a red, a blue, and a green. The red one is the international stock market. I'm showing this to you from the high of 2021. So December 31st, 2021, where the market peaked out, whether it was, the last day of 2021 or the first day or two of 2022, you get the point. That's where the market stopped going up. And let's just, for easy math, call that a year and a half ago. We're almost basically kind of sort of back to that price again. What I wanted to show you on this price chart, if you look at this price chart right here, all the markets are kind of moving together. The red line is international, the blue line is US, and the green line is a mix of the two. The green line is all world, so the entire planet. Now, it is priced in the US dollar, so it has some influence that. But what I want you to notice is they all kind of fell together. They all kind of stopped falling in that September, October of last year, and they all kind of rose together. Yes, international went up much faster up until probably, let's call it February of this year. And then it started hitting some upside resistance. But if you look at that, I'm going to say all three markets, really the US market and the international market, and the green line shows them both together. They're all kind of moving together, meaning they're all listening to the same information right now, and the same information is affecting them the same. So if in fact Japan, which my guess is they are, I'm not going to bet on it, my guess is they need to increase that because Japan needs inflation. Unlike other parts of the planet, there's been a very deflationary-like situation in Japan for decades. And they want to control how much inflation happens. And their stock market's doing well. It has still not broken above its 1989 highs, which is, oh my gosh, 35 years ago. But that's what's happening. So the market's in sync, for better or worse. Whether you own international or you own all world or you have US domestic, everything's moving in sync right now. By the way, that happens sometimes. It typically happens more when the market is doing well than when it's not. And so that's what we have right now. Now, why am I bringing this up and why am I talking about this? Because we're at the old lifetime high, and I've talked about this before, one should expect more volatility. Now, if yields start moving higher on the 10-year Treasury, bond prices are going to move lower. This is a little crazy because the bond market in the US it had its worst fall in 250 years. And there's the largest large speculators. It's the largest large speculators short position on bonds ever. Now, I talked about last week, the last time there was, or the previous record of the large short positions, the bond market actually rallied. So we could actually see more price volatility in the bond market over the coming weeks or months than in the stock market. For no other reason than there's a huge short position on US bond prices. Let's think about prices. And US yields are getting competition. Yes, I know it's only 44 basis points, but if that goes up to 55 basis points or 60, think of it as 0.6%, that will have some people shift their money to the Japanese yen from the dollar or from US bond markets to the Japanese bond market. And that will create some instability, which is expected with the stock market being back up here. And so the takeaway is more price volatility, which is what I've been talking about. Expect there to be price volatility as the market, I believe, pushes its way higher, but not over the next, 5 days or 10 days. I'm just making up that time frame, but we're going to have some price volatility because everything is all connected, not always the same way, but expect some downward pressure on equities all over the world, whether you're US and in high growth or you're overseas and in deep value. Expect some price or some stock downward pressure going on. Thanks everyone for being in my world. I appreciate you watching these videos. I've been doing them for a long time. I have over 500 videos on YouTube. I started giving my beliefs and ideas and insights on the market back in 2003, also known as 20 plus years ago. And as I said last week, I'm going to start to roll up or shut down where I give market reviews for free. I do it for my money management clients. I do it every Tuesday. And it just doesn't feel right anymore to be giving this away for free. I do thank you for being in my world. And as I said last week, and I will say probably for the next 4 or 5 weeks, that I am going to shut down these market reviews and give more. I'll still do videos, but there'll be more of what to expect in retirement. What's the 3 biggest mistakes you do in retirement? What are the things to look for a good advisor in retirement? Things like that. That's more financial planning, financial advising. And quite honestly, that's what all of my competitors are doing. None of my competitors do this type of stuff. Thank you. Let me know where you think I got it right, where you think I got it wrong. If you're curious what it might look like for me to manage your portfolio in retirement to make sure you can lower volatility and make sure you get the big picture right, you can just go down below and get on the calendar. Please don't ask in comments what that looks like. It's not as simple as A, B, and C. It's really done through what we call a portfolio x-ray, also to see if we might be a fit. Thanks so much. I appreciate you being in my world, and I'll see you on the next video. Okay, bye.